And welcome to Confident Compounding with Corey Kramer. Today we're going to be analyzing Old Dominion Freight Line stock, ticker ODFL. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments. I usually go through a couple times a week. I put the tickers up on the chalkboard behind me, and eventually I'll make you a video. I either post those here on YouTube or the free tier over on Patreon. So make sure to check out that link down in the description. I also have weekly picks over on Patreon for $25 a month. And I now have a full service over on Patreon as well, which I'm currently building out and developing this summer. But we are up and running. So those links will all be in the description, as well as a affiliate link for Fast Graphs here for 25% off if you want to go check that out. They have free trials. As always, not individual investing advice, just how I analyze stocks. All right, Old Dominion. So this is a trucking company. When we look at their historical earnings, they've been moving the right direction, up and to the right. That's kind of the green shaded area here. Can get rid of dividends. But let's take a look at the cyclicality during the Great Recession to get an idea of what we have here. So technically, these guys did fall about 50, earnings did fall about 50%, just almost right on the dot, actually, during that decline. But so often if I see that, and in transportation, which can be pretty cyclical, I would treat this as a cyclical business. So this one's actually kind of right on the borderline in terms of the earnings. Usually about 50% decline off the high is where I would switch over to use a more cyclical approach rather than an earnings-based approach. But in this case, the price did not fall as much as the earnings. So let's look at, what do I want to get rid of here? Fair value ratio, so we can see the price a little bit more. And then shrink this. Okay, I just wanted to get a little more definition in the price here in case my eyes were deceiving me. So the price fell about 50%, which is a lot. That's about the minimum we would want a cyclical business to fall in order to invest in it, to fall about 50% off the highs. However, we know that the wider stock market in the S&P 500 fell more than that, fell over 60%. So even though earnings were, we'll call it moderately cyclical, the stock price was definitely fell. Relative to the market, it wasn't any more cyclical than the rest of the market. And also, earnings recovered within 1 year. So sometimes these trucking cycles can be really quick, especially if you're one of the bigger guys. So I'm going to use a standard earnings-based analysis instead of the cyclical one, but I'm going to use a method that I use for recessions to account for this kind of earnings action here. Because if you look at it, it would have had a 26 PE, which is pretty high, during one of the best times to buy it, right? I don't know. Let me widen this a little bit. But the rest of this time, the PE would have been lower, like in the teens. So you can't really trust that PE ratio near the bottom of the cycle. And we're kind of getting one of those dynamics now where earnings are falling. So we need to be careful about looking at that 30 PE and thinking it's super high. It actually is pretty high. But even if it fell quite a bit, if earnings kept falling, it would kind of never look good, basically, if earnings kind of fell similarly as they did back in 2008 and 9. So the mistake that an investor could make with a stock like this is to look at the PE ratio after the only example I have, unfortunately, is this decline, is to look at the PE ratio here, like right at the bottom. I mean, that's not the exact stock price bottom, but it's the bottom of the earnings decline toward the end of 2009, and say a 33 PE. That's crazy. Earnings just fell 50%, and I'm going to pay a 30 PE. But it actually wasn't expensive because earnings were about ready to rise 115% and recover. So you want to be able to anticipate that. You know, you could look at when the stock price was higher here and the earnings will almost double we can even go to where it about doubled, about right there. The PE then was half, right? So it looks cheaper, but it actually costs twice as much if you waited a year and a half to buy it. So that's the mistake we want to try to avoid. One of the mistakes. The other one is kind of already in progress, so probably fewer people are about to make it, but maybe not, because the stock price has fallen a bit. And I'll talk about this a little bit later. Yeah, it is down like 30%. So it is at least trending in the, from my perspective, right direction, because I don't own the stock. And so we do, and it is high quality enough. We looked at the earnings trend over time that we do want to keep an eye on it. Now we can see it had this big earnings bump from the COVID stimulus and the supply chain issues and everything. And so that's naturally going to wind down. We aren't actually in a recession yet, even though their earnings have been falling the last 3 years. This is really just a correction, in my view, still coming off the COVID decline. If we go one more year and the economy picks up, that'll probably be a complete normalization. And then whatever the economy does is probably going to dictate kind of what happens with earnings and the stock price going forward from here. Okay, now let's get into the valuation part of it. And when my spreadsheet loads here, hopefully soon, I will get into the numbers. Now, what I want to try to do here is to anticipate, there we go. Adjust my head a little bit. Okay, so we have Old Dominion Freight Line. Now, we'll get right into where my buy prices are. They're almost 50% lower. This is the one I'm actually using that's set up for a recession. It's modeled on that 2008-2009 recession, which I think is fair, even if we have a moderate recession instead of a bad one, because we're still coming off of the COVID boom bust, right? So I'm using the peak earnings of the boom here as kind of a cyclical peak in order to calculate this. Now, the interesting thing is, if I just do my normal calculation and I assume they can grow earnings at 10% after this year, then the buy price when I do that is also about $80, $79, actually slightly lower now. Now, as earnings continue to disappoint, so I just updated these earnings for this year to 510. I want to say it was at like 530 the last time I updated it, so they're deteriorating. So as those current earnings or forward earnings fall, the standard norm, I call it normal buy price, this will fall as well. This will keep getting lower and lower as the current earnings fall. Or it will get higher if the earnings are better, but that's not the trend we're in right now. This buy price, however, will stay the same now. So it used to be the normal buy price was much higher when we expected earnings to be higher, or when they actually were higher a couple years ago. But now that earnings are disappointing, this is coming down. This buy price is based on the peak earnings, which I have in here as 609. Look at the fast graph, make sure that's the same. Yeah, so I have it at 609 as their peak earnings. So what I'm trying to do is I'm going to hold this peak earnings number steady and create a PE with this earnings and the stock price. So I might need to refresh this now. I call that the recession PE. And when I do the same thing back, and it's based on what it did back in 2009, right? So this helps mitigate the problem of these falling earnings creating this really high PE. What I would do instead here is to use this price at this, I'm just picking this time at the end of 2009 because that's when earnings bottomed. The price was like $4.82. I would use that, but back then the peak earnings peaked at 29 cents. So about double what they actually were, which means the recession PE back then would have been about half of the 34. So it would have been more like 12. Okay. And so based on that, I model that and I take that same method and apply it to now. So if anything's kind of similar to back then when earnings fall 50%, then that's how I get my buy price. I realize that I kind of didn't get into the super details of that, but I'm trying to explain the big picture here. Because what will happen is you saw that the PE was like 33 when it really should have been half that, like 12 or 13 or something like that. So it would look much more attractive, which is what you want, because you're assuming those earnings that have fallen 50% are going to recover within usually like a couple years. In that instance, they recovered the next year, so it was quite dramatic. So this is basically assuming at some point the down cycle will end and you could buy it. So as we go forward, my buy price, which looks quite low probably now, if earnings disappoint, my buy price will start looking more and more optimistic and the market will get more and more negative, is usually what happens. Especially if they fall 50% off the high, which I think they're only, what are they now? Let's go to modern day here. They're only 8, 11, we'll call it 20% off the high now. So if earnings fell another 30% over the next year and a half, maybe it's not this year, but maybe it's next year, and there's a recession, if you think about that in your mind, you could very easily see the stock price fall 50% from the levels that it's at now. And at that point in time, people will be much more pessimistic. They'll have 1, 2, 3, 4 years of negative earnings growth with a big drop at the end. The stock price is down 30% now. It will probably be down 50 or 60% by then. And everybody that had bought the stock in the past 5 years would be underwater and everybody would hate it. And that's when you want to buy, basically. And then you hope that a recovery happens in a timely manner. One other thing I saw back here was I did write an article for Seeking Alpha, which I have linked in my spreadsheet from a couple years ago. Let's see if it'll load. Yep. So Old Dominion is extremely overvalued. That's July 6th, almost exactly 2 years ago. And then we'll see how it's done. So since I wrote that article, and usually it takes 2 or 3 years, sometimes for valuation articles to actually happen in real life. It just takes time. So it's down 15%, while at the same time the S&P 500 is up 35%. So when I had a sell rating. So that would have been a good sale. You could have taken profits when it was expensive. I think I just did a basic valuation analysis and it was just off the charts expensive. And I figured that the decline that we're having in earnings now is going to come. I'm actually kind of surprised it happened as gradually as it did. But you can see where these valuation techniques come in handy. They can just keep you out of the biggest, most obvious mistakes. Now, soon after I wrote that, when did I write it? During this rise. I mean, for a little while, it kind of held its own there. But now we're seeing the force of the earnings finally take control, I guess, or the weight of them being felt by the company. Now, at the macro level, things don't look real good for like the goods economy still, with tariffs, negotiations still going on, just general, I don't know, chaos sort of in the goods area. So it's hard to say kind of what happens there. But when you buy something when it's cheap, if this does get 50% lower, I mean, the news is going to be bad. So you have to have a plan ahead of time. Now, sometimes things hit my buy prices and I do look at it again and I, see if something really has changed from in the past. And then, with the context that it's going to be bad at the moment, to ask whether the bigger trend is going to kind of come back in a reasonable time frame, which is usually a few years, because if you buy a stock like this when it's down, maybe this is even a buyable dip here. I don't know. Yeah. So let's say that's a reasonable buyable dip. Even though the stock's off its highs, you would have been up 300%. So, and even if this was priced correctly at half maybe what it is now, or 30% more lower, you would still be up a couple 100% and you would still have good returns, but you have to buy them when they're at good prices. And then, I mean, if you would have done that and taken profits when I wrote my article, somewhere right around there, you would have been up over 300%, right? So that would have been a great gain. And then you can be patient. I mean, if you're patient, you can afford to wait and you ultimately take less risk. Even if you've just been holding cash, you would have earned 5% the last 2 years. Just waiting for the opportunity. Maybe you can buy the same stock, but I don't always focus on the same stock. Just waiting for opportunities that come along in the market that offer you a better risk reward than they currently have. So right now, I mean, it's not as overvalued probably as it was, but I mean, it might still be a sell. I'm not predicting it has to go down 50% from here. It looked pretty overvalued based on just even the earnings metrics, honestly, because it was under 5% 10-year CAGR. So it probably still is a sell, but I wouldn't be like banging the table necessarily on it. I would probably be looking for something better to put my money in, though. Put it that way. Okay, so hopefully you found this useful. If you did, hit the like and subscribe button. If you have a request, put it down in the comments. I'll see everybody later.